Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to the week that was. Indian assets came under pressure for the second week amid weak global cues as markets repriced implications of the hawkish policy guidance by global central banks at the Jackson Hole Symposium. After a weak start, Indian equities recovered but remained volatile through the holiday-shortened week, posting losses in the last two trading sessions. The Nifty index fell 0.1% over the past week and outperformed most regional peers. With this week's loss, the Nifty index YTD 2022 price returns turned negative 0.5%, and the gap from its October 2021 peak increased to 5.1%. Broader markets continued to outperform Nifty, with the mid-cap index up 0.6% and the Nifty small-cap index up 0.2% over the week. Among sectors, telecom and realty were the best-performing sectors with returns of over 3%, while IT and metals were the worst-performing sectors with cuts of over 2% during the week. Indian fixed income markets remained under pressure as bond yields edged higher across the curve amid lower demand, rising US bond yields, and unwinding of the expectations of India's sovereign bond inclusion in global bond indices. For the week, the 10-year Indian government bond yield rose by 2 basis points to close at 7.23%, while the 3-year and 5-year Indian government bond yields rose 7 basis points each over the week. The INR recovered as a reversal in crude oil prices and robust foreign investor inflows negated the impact of rising US bond yields and strengthening US dollar. For the week, the INR rose 0.1% to close at 79.78 per dollar. Over the week, we had a few macro data points reported. The first was on India's Q1 FY23 real GDP and GVA, which grew 13.5% and 12.7% respectively, compared to a 4.1% and 3.9% growth in the previous quarter. Though on a sequential basis, there was moderation. However, the industrial sector output growth rose 8.6% year-on-year due to improvements in construction activity, which recorded a growth of 16.8%, electricity, which recorded a growth of 14.7% year-on-year, and manufacturing sector grew 4.8% year-on-year. Services sector also witnessed a broad-based recovery, rising 17.6% year-on-year, supported by trade and transport, public administration, and defense services. Private consumption grew 21.3%, was 2.3% growth in the previous quarter. The GDP deflator for Q2 was significant at 11.3%, which was the highest over the last decade. The second data was reported on India's manufacturing PMI, which eased marginally to 56.2 in August 2022 from July's reading of 56.4. Both output and new orders expanded at the fastest pace since November, and new export orders rose. On the price side, input cost inflation slowed at a 12-month low due to softening in commodity prices, while output prices remained stable. The third data was on India's fiscal deficit for the period April to July of FY23, which stood at 20.5% of budgeted estimates compared to 21.3% for the same period last year. The government's total expenditure was at INR 11.3 trillion, or 28.6% of the budget estimates, almost the same as in the year-ago period. The total receipts, including taxes, stood at 7.9 trillion, or 34.4% of the budget estimates for FY23. At this point, I'll take a pause and thank you as always for listening. If you find this podcast useful, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.